a completely foundational, no-nonsense financial concept: USA-based investment fundamentals. Our source material today is incredibly brief, but man, is it deliberate. It totally distills the American style of investing, a style that's so often defined by hard data, really clear graphs, and undeniable visual evidence, right down to its absolute core philosophy. Today, we're going to break apart this exact phrasing, explore the real conceptual weight of these terms, and figure out why stripping literally everything back to this exact foundation is absolutely crucial for focus strategists.
So think about this for a second. If you just cut through the daily ticker tape and all those flashy charts we constantly see, what actually builds the American market, right? We hear endless debates about market trends, but the source material forces us to look right past all of that noise and ask a much more grounded question. It points us straight toward a structural reality. It basically demands that we stop looking at the superficial layers of finance and instead look at the bedrock. This is really all about the American style of market building. We're talking scale, pragmatism, and totally unyielding data-backed structural foundations.
Now, to really grasp this, we have to start by defining an investment fundamental exactly as it's derived from our source text. It is the essential underlying core principle of allocating capital. When our source explicitly pairs the word investment with fundamental, it's demanding that we ignore the market noise and focus on durable, verifiable metrics of capital allocation. It asks us, really, it tells us, to focus exclusively on core principles that have inherent structural integrity, stuff backed by hard evidence, not just some abstract theory floating out there.
And you can contrast this directly with speculation. Look, speculation is inherently about guessing, right? It's kind of like hoping the wind blows in your direction. It's totally fleeting, and honestly, a massive distraction. The investment fundamental, on the other hand, relies on concrete reality and highly measurable, graph-backed outcomes. Notice how the source material doesn't use a term like investment theory or investment guess. No, it uses the word fundamental. And that deliberate choice acts as this incredibly strict filter, totally separating serious, grounded strategy from risky, short-term gambling.
As you'll see here, these three core concepts form a completely focused strategic loop. It's like a giant puzzle where every single piece is absolutely critical. You identify the capital allocation. You ensure it's solidly grounded in a core principle, and then you anchor it in a robust geography: the investment, the fundamental, and the USA base. If you take out just one slice, the whole framework fails. It's a perfectly closed loop of logic that literally demands strict adherence to all three elements if you want the strategy to hold up under scrutiny.
Section 1. The core fundamentals: building a practical methodology.
Okay, so this source gives us a really strict three-step framework. Step 1, identify the target vehicle. Step 2, ensure it possesses durable structural integrity, like does it actually rely on essential core values? And Step 3, confirm it passes the USA-based geographic filter. By applying this exact logical flow to your financial perspective, you just strip away endless complexities. You're basically left with this highly focused, highly disciplined checklist that acts as a real guardrail against making poor decisions.
Check out this quote directly from the text: investment fundamental hyphen USA based. Notice that hyphen literally connecting the concept directly to the location and the distinct capitalization. The brevity here is absolutely the point. In a financial world that is just overflowing with complex data images and endless charts, this phrase acts as a totally strict singular filter. It's this stark reminder that the most durable strategies are very often summarized in just a few perfectly selected, uncompromising words.
Now look at how the American market style relies heavily on transparent, graph-driven structural reality. This grants any fundamental rooted here in unmatched scale and incredibly deep institutional liquidity. When an investment fundamental is explicitly anchored to this baseline, it literally inherits that massive scale. It's no longer just a sound theory on paper, it is a sound theory backed by one of the most significant and quantifiable economic engines in the entire world. To put that into perspective, it's just on a completely different level than a non-specific fundamental.
Moving on to Section 2, the USA-based approach, the structural anchor.
So the absolutely crucial point here is that these investment fundamentals aren't just floating around in the ether. They are strictly and powerfully rooted in the USA. And you might be wondering, why is this so important to the source material? Well, because context matters. A fundamental principle in one environment might just completely fall apart in another. By explicitly stating USA-based, the strategy deliberately attaches itself to the regulatory environment, the consumer base, and the innovation ecosystem inherent to the United States. It's a very pragmatic, calculated decision to rely on a specific known foundation rather than some abstract, globalized unknown.
This entire framework boils down to this. It requires a singular, absolutely uncompromising focus. When your entire philosophy is distilled into investment fundamental-USA based, there is zero room for a plan B, C, or D to distract you. It requires singular discipline. That means having the absolute fortitude to say no to 1,000 other shiny opportunities, simply because they don't fit this exact one-track criteria. Honestly, narrowing your vision in this way is exactly how you achieve absolute, measurable clarity.
All right, let's quickly summarize our map here. First up, we have the investment focus, which is all about avoiding the noise and ditching the speculation. Second, fundamental principles. These have to be structurally sound, relying on essential values that actually stand the test of time. And third, a USA-based application, which systematically leverages the massive scale of the American market. These 3 points, together, form a complete, rock-solid framework for navigating the text.
If you're looking to build wealth on your home turf and you want to understand the exact concepts that set the stage for market participation, well, you are absolutely in the right place. Let's just get right into it.
So I've got a question for you right off the bat. Are you ready to dive into the U.S. market? I mean, that's the ultimate American dream, isn't it? Building real wealth, taking control of your financial destiny, really stepping up to the plate. Today, we're going to explore exactly how our source material tells us to do just that, breaking down this single powerful sentence that charts out the whole course.
Okay, here is our game plan for today. First, we'll unpack the U.S. market promise. Then, we're going to look at defining the best strategy. And finally, we'll figure out what it actually means to be ready to dive in.
All right, let's kick things off with Section 1, the U.S. market promise, building the foundation.
You know, every winning playbook needs a solid introduction to the playing field before you can actually score. So let's set that foundation. Our source material kicks off with this incredibly direct, powerful phrase, U.S. Stocks Introduction. And what I really love about this is just how unapologetically focused it is. There's no getting distracted by international noise or super complex alternative assets here. We are zeroing in entirely on domestic equities. We're talking about the companies built, grown, and thriving right here in our own backyards.
By definition, U.S. stocks represent the foundational asset class we're examining today. These two simple words, they're really the core engine of our financial exploration. We're keeping our focus strictly on the home turf, making sure we understand the very market that's driven American innovation and economic strength for decades.
Now, what's really interesting about this specific word, introduction, is how it tears down barriers. Because let's face it, Wall Street can sometimes feel like this exclusive club with a massive velvet rope, right? It's almost designed to intimidate the everyday American. But our source text, it completely tears that rope down. By framing this as an introduction, it assures us that this is an accessible starting line. You don't need a fancy finance degree to get started. You just need to be willing to take that first step and learn.
Moving right along, let's hit Section 2, defining the best strategy, your playbook.
Okay, so this is where we transition from just observing the field to figuring out exactly how we're going to play the game to win. The text doesn't just stop at giving us an introduction. Oh no, it immediately follows up with the phrase, with best strategy. And this is a real game changer. It completely elevates our source material, transforming it from a simple, passive primer into this active, actionable blueprint. It's telling us we aren't just going to casually read about the market, we are going to attack it with a defined, superior plan.
Now, what's really interesting about this slide is the clear contrast here. Most folks, well, they settle for a standard strategy. It's average, middle of the road, kind of just crossing your fingers and hoping for the best. But our text explicitly promises the best strategy. It absolutely demands excellence and top-tier planning to navigate the American financial landscape.
So the crucial takeaway is this. Best strategy literally means the ultimate optimal approach for tackling the market. And this phrasing is just incredibly empowering. It really sparks that classic American can-do spirit. It implies that the absolute optimal path has already been identified in the text, and it's just sitting there, waiting for you to use it. You aren't out there guessing. You are executing with precision.
All right, let's bring it home with Section 3, ready to dive in, taking action.
This is where the preparation finally meets the pavement, and we get to the absolute most kinetic part of our source text. The final piece reads, to dive into the U.S. market. There's just an incredible, fearless energy to those words. Notice it doesn't say to carefully dip your toe into the U.S. market. No way. It says to dive. It calls for total commitment, really urging us to jump headfirst into the domestic arena with absolute confidence.
Doing this requires a total shift in mindset.
You really have to move away from hesitation. Waiting on the sidelines, getting paralyzed by analysis, letting the opportunity just pass you by while the market moves on without you. Instead, diving into the market is all about the bold, decisive action explicitly called for by our source material. It's about moving past fear and finally taking ownership of your financial future.
So let's see how this builds our complete roadmap. It's actually amazing how our incredibly concise source text outlines this perfect, logical, three-step action plan for any American ready to build wealth. Step 1, you grasp the introduction. You understand the basics of U.S. stocks. Step 2, you equip the best strategy. You don't just act blindly, you prepare to act optimally. And finally, step 3, you dive into the market. You execute without hesitation.
When we summarize the entire deconstructed phrase from our source, we're left with these undeniable core playbook directives. 1. Focus strictly on U.S. stocks. 2. Secure an introduction. 3. Utilize the best strategy. And 4. Dive into the market. These aren't just words on a page, folks. They are pragmatic, powerful commands that form our ultimate playbook for domestic financial success. Which leaves us with this final, vital question. Armed with the best strategy, are you prepared to utilize this introduction and finally make your move? The source text we explored today isn't just a casual observation. It is a direct challenge to step up and actively participate in the American economy. The playbook is open, the strategy is defined, and the market is waiting.
Look, if you've been watching the shifting yield curves lately, or just trying to figure out how to protect your hard-earned money, you know that keeping your cash safe is absolutely top of mind for everyday Americans right now. Today, we're diving right in and taking a strategic look at a massive cornerstone of the American financial system, government bonds. Let's demystify this whole thing.
Think about this for a second. What if you could actually become the bank for the U.S. government? Literally flip the script. In our modern economy, we're all so used to paying institutions to borrow their money, right? Mortgages, car loans, credit cards. But using U.S. bonds flips that dynamic completely. You step into the role of the creditor, and the entity paying you for your cash? The United States government.
To respect your time, we've broken this explainer down into 3 simple, high-value parts. 1, an introduction to U.S. bonds. 2, how U.S. bonds actually work. And 3, the best practices for using them.
Okay, let's dive right into this. Part 1, Introduction to U.S. Bonds, the Foundation.
At its absolute core, a U.S. bond is basically just a simple IOU between you and Uncle Sam. You're lending money to a trusted friend, in this case, the country, to help fund its operations, and they promise to pay you back with a little extra. And the scale here is just staggering. We are talking about a massive pool of over $25 trillion in the U.S. Treasury market. By getting in on this, you're securing a contract where the government is legally obligated to return your money plus a fixed yield. It's essentially the ultimate risk-free rate.
All right, moving right along to Part 2, How U.S. Bonds Work. The Mechanics.
The lifespan of a bond is incredibly predictable, which is exactly why people love them. It's literally just 3 steps. Step 1, you buy the bond. You hand over your cash. Step 2, you earn interest over time. This is called the coupon rate, and it just means you get periodic interest payments while you hold the asset. And finally, Step 3, the bond hits maturity, and you get your original money back. Buy, earn, mature. It's that rock-solid predictability that makes bonds such a vital tool for lowering your financial risk. And that predictable cycle is exactly why bonds are the ultimate stabilizer for your wallet. Think about the stock market. Sure, equities offer great growth potential, but they're an absolute roller coaster, right? The volatility can be super stressful. If you only have stocks, a bad economic shift can really drain your savings. U.S. bonds, on the other hand, act like a massive stabilizing anchor. They aren't going to double your money overnight, no way. But that's not their job. They're there to protect your capital and give you a reliable yield when the stock market gets choppy.
Now, not all anchors are created equal. You basically have 2 flavors, short-term and long-term. Short-term bonds are great because they tie up your money for less time, meaning you have quicker access to your cash, but they usually pay a lower interest rate. Long-term bonds, where you might lock in your cash for a decade or more, generally pay higher yields to reward your patience. But keep in mind, long-term bonds can be a bit more sensitive if overall interest rates change before it's time to cash out. Figuring out how to balance these two is where the real strategy kicks in.
So how do we use this for your specific financial goals? Let's get right into Part 3, U.S. Bond Best Practices. The strategy. Now, what's really interesting about this slide is how these three core actionable practices work together to optimize your money. First, hold your bonds to maturity. This pretty much eliminates the risk of price changes in the secondary market. Second, build a bond ladder. This ensures you always have cash freeing up. And third, diversify your portfolio. Mixing bonds in with your broader stock investments means you get to enjoy the growth of the market while still maintaining that rock-solid floor provided by the U.S. Treasury.
Let's zoom in on that second point, bond laddering. This is an absolutely crucial tactic. It's a real game changer for everyday Americans trying to balance their financial strategy. Instead of taking all your fixed income cash and dumping it into one single 10-year bond, you stagger it. You buy some 1-year bonds, some 2-year bonds, and some 3-year bonds. It's like building steps on a ladder. Because they have different maturity dates, you constantly have bonds finishing up and returning your cash. When one matures annually, you can either spend that money or just reinvest it at the top of the ladder into a new long-term bond. This means you have a steady stream of returns, and you're always capturing optimal yields no matter what the economy is doing.
And here is the magic number 100%. If you stick to that first rule we talked about and hold a U.S. government bond all the way to its maturity date, you are guaranteed to get 100% of your principal back. Think about that for a second. We live in a world of wild crypto swings and shifting real estate markets, but this guarantee, backed by the full faith and credit of the United States, provides a true, literal, risk-free baseline for your wealth.
So the crucial point is this. Securing your financial future isn't just about trying to hit the jackpot with the hottest growth stock. It's about disciplined capital preservation. By actively managing your timelines, using straightforward strategies like building a bond ladder, and anchoring everything with U.S. Treasury backing, you are building an incredibly resilient, all-weather foundation for your personal financial security.
You now know the mechanics, the duration, strategies, and the very real structural advantages of sovereign debt. So I'll leave you with this question. Take a hard look at your own portfolio's risk profile today. In such an unpredictable economy, are you ready to anchor your financial safety net, or are you leaving your money fully exposed to the storm?
If you've ever felt like the financial world speaks this overly complicated language just to keep you out, hey, you are definitely not alone. But today, we're stripping away all that confusion. We're going to take the fundamental concepts of mutual funds and turn them into a direct, actionable playbook. By the end of this, you're going to have a crystal clear understanding of exactly how to put your money to work for you. But before we get into the nuts and bolts, I want you to ask yourself a very direct question. What is really standing between your hard-earned cash and its true potential for growth? For a lot of hardworking Americans, the answer is just hesitation. It's leaving money sitting in a standard savings account or literally stuffed under a mattress, where inflation just silently eats away its purchasing power year after year. Think about it. If inflation averages just 3% a year, cash sitting idle loses nearly half its value in just over 2 decades. That is a staggering loss. But the time-tested, totally accessible solution to this problem of stagnant cash? Mutual funds. Okay, let's dive right in. Here's our straightforward roadmap for today. Number 1, mutual funds explained. Number 2, investing best practices. Number 3, how to start investing. And finally, number 4, choosing the right funds. Let's kick things off with Section 1, Mutual Funds Explained. It's time to clear the air, strip away the Wall Street jargon, and build our absolute basics. Now, what's really cool about this concept is how it takes a totally misunderstood idea and just simplifies it. A mutual fund is essentially a vehicle for collective investment. I want you to think of it using a very plain English analogy. Just picture a giant basket. You, along with thousands of other everyday Americans, pool your money together into this basket. Then, a professional manager uses that collective cash to buy a really wide, diverse mix of hundreds of stocks or bonds. So, instead of betting your entire life savings on one single company and crossing your fingers it doesn't crash, you actually own a tiny, heavily protected slice of the entire market. It's collective financial power working directly for your individual wallet. Moving right along to Section 2, investing best practices. Because building sustainable wealth isn't about getting lucky, it's about rigorously following the established rules of the road. Consider this your mandatory checklist for your personal financial road trip. To succeed, you've got to adopt these core best practices. That means prioritizing long-term patience over short-term panic. Look, investing is a marathon, not a sprint. Letting compound interest do its thing over a 30-year career, that is absolutely your greatest asset. It also means using diversification as your shield to protect your cash from sudden market drops. And this is absolutely crucial. You've got to check your management fees, often called expense ratios. Even a seemingly tiny 1% fee can literally eat up tens of thousands of dollars of your returns over a lifetime. Keep those costs low. Also, employ strategies like dollar cost averaging, which is just investing a set amount every single month whether the market is up or down. That's how you build an unshakable financial foundation. That brings us to Section 3, how to start investing. Here is where we shift gears from understanding the theory to actually taking action. We're talking about a literal 1, 2, 3-step process to get in the game. It takes all the abstract financial advice out there and turns it into a concrete, empowering action plan. Step 1, decide where to house your funds. For most Americans, this means opening a tax-advantaged account like an IRA or maxing out a 401k through your employer, especially if they offer a company match. Seriously, a match is literally free money. Don't leave it on the table. Step 2, connect your standard American checking account to that brokerage platform. And Step 3, automate it. Set up automatic payroll deductions so that every time you get paid, a small portion is instantly invested before you even have a chance to miss it. It really is that straightforward. It turns your wealth building into a true set-it-and-forget-it system. Which brings us to our final section, choosing the right funds. This is the ultimate piece of the puzzle, drafting your portfolio. Figuring out exactly what to buy basically comes down to weighing different strategies against your personal timeline. Are you looking for the rocket ship growth of aggressive stock funds to build wealth for a retirement that's still decades away? Or do you need the shield of conservative bond funds to protect cash you're going to need very soon, like save for a down payment on a house? You can filter these choices without getting lost in an ocean of complicated ticker symbols. All you do is align your specific American dream, whether that's a college fund for the kids, a suburban home, or a quiet beach retirement, with the risk profile of the fund. You're deliberately choosing the specific basket that matches your exact timeline. When you connect all these pieces, foundational knowledge, study habits, and the right fund selection, you are finally in the driver's seat. You completely transition from being an anxious saver losing money to inflation to becoming a confident investor building true generational wealth. By mastering the core concepts, implementing disciplined best practices, setting of automated execution, and deliberately choosing funds that map directly to your life goals, you take total control. This is what real empowerment looks like for your wallet. You're moving smoothly from the basics straight through to confident execution, making the once complex world of investing totally accessible. The concepts are demystified, the practices are clear, and the step-by-step execution is right in front of you. The playbook is wide open. So the only question left is, are you ready to step up to the plate and take action on your financial future today? Today, we're diving into something I am super excited about, Main Street's Guide to Wall Street. We're going to focus on the serious mathematical advantage of the good old index fund. For decades, the whole American wealth building story has been totally dominated by Wall Street insiders. But today, we're stripping away all that complexity to give you a direct, actionable framework so you can capture that long-term market growth for yourself. So let's start with a really basic question. Why does investing feel so intentionally complicated? Seriously, just turn on any financial news channel. It's this constant, overwhelming stream of tickers, volatility alerts, and guys in suits debating alpha and beta. But here's the thing. That's not just noise. It's basically a gated community built on complexity. The financial services industry kind of relies on this intimidation factor, right? They want to convince the everyday American investor that you absolutely need a highly paid professional just to navigate the market. But we're cutting right through that today. Here is our roadmap for this explainer. First, we'll look at the investing dilemma. Second, we'll meet the index fund. Third, we'll go over the core best practices. And finally, we'll lock in your long-term strategy. Let's get right into it. Section 1, the investing dilemma. Keeping your hard-earned dollars. Okay, so think about the life cycle of a single hard-earned American dollar that you decide to invest. On one hand, you've got the incredible power of compounding. That's your money working efficiently 24/7 to build your American dream. But on the other hand, you have the invisible tax of active management. Wall Street has basically spent forever selling us this illusion that high-fee fund managers can consistently beat the market, but mathematically, it's a completely different story. Those expense ratios, which are often around 1 to 2% every single year, create a massive drag on your portfolio. Over, say, a 30-year timeline, these fees act systemically. They literally eat away hundreds of thousands of dollars of your compounded growth. And the absolute kicker? They take that cut regardless of whether the fund actually performs well. All right, moving on to Section 2. Meet the index fund, the ultimate sampler platter. So, how do we bypass those crazy fees? We turn to the absolute hero of modern personal finance, the index fund. Honestly, the easiest mental model for this is thinking of it like the ultimate American barbecue sampler platter. Instead of agonizing over picking just one single winning stock, which, let's be real, carries huge risk, an index fund gives you broad market exposure all at once. For example, if you buy a fund that tracks the S&P 500, you're basically buying a tiny, fractional share of the 500 most profitable companies in the U.S. economy. You own the whole basket. It's instant, low-cost diversification, just like that. And the contrast in risk between these two approaches is just night and day. On one hand, picking single stocks is basically pure concentration risk. You have to constantly monitor earnings, try to outguess the market sentiment, and your portfolio is incredibly vulnerable if just one company messes up. But on the flip side, owning the index shifts your entire strategy. Because you own the whole basket, a really bad quarter for one company is completely offset by the success of the others. You're no longer placing stressful bets on individual corporate anomalies. Instead, you're investing in the relentless, historical, upward trajectory of the broader American economy. Let's look at how to actually do this in Section 3, Core Best Practices, the Everyday Investor's Playbook. Executing this strategy really comes down to 3 incredibly simple pillars. You don't need a finance degree for this, I promise. Step 1, start early. You want to leverage the mathematical certainty of compound interest. Let time do the heavy lifting. It is way more powerful than trying to chase high yields. Step 2, buy consistently. This is called dollar cost averaging. Basically, you automate your investments with every single paycheck. It totally removes the emotion from the equation, so you're buying shares whether the market is up or down. And step 3, ignore the noise. That 24/7 financial news cycle, it is literally engineered to trigger volatility-induced anxiety. A true index investor relies on behavioral discipline. You got to treat your portfolio as a long-term wealth vehicle, not some reactionary day trading account. These steps actually form an ironclad defensive strategy to protect your wealth. First, by using index funds, you drastically cut those expense ratios because they run passively on algorithms, meaning the yield stays in your account where it belongs. Second, you rely on that mechanical consistency we just talked about. And finally, and this is a big one, you insulate yourself against loss aversion. Look, human psychology naturally prompts us to panic and sell during a market correction. We get scared. But selling during a downturn just locks in your losses. By holding the index, you trust the structural resilience of the U.S. market to recover, exactly like it has after every single economic recession in our history. This brings us to Section 4, your long-term strategy, freedom over frustration. If there is one single golden rule of modern investing that you take away from this explainer, let it be this. Time in the market is always greater than timing the market. The financial industry makes so much money selling the illusion that you can tactically jump in and out to catch the exact tops and bottoms. But the data shows that virtually no one actually does this consistently. The real secret is just capital deployment and patience. You just let the structural growth of the market do the heavy lifting, compounding your capital until you reach genuine generational financial freedom. So we've stripped away the Wall Street jargon to reveal the real structural advantage of index investing. You've got the playbook now. Eliminate the drag of high fees, grab that broad market diversification, and use the unbeatable strategy of automated consistency. The tools are fully accessible to everyday Americans, and the path forward is crystal clear. So the only question left to answer is, are you ready to stop timing the market and start letting the market work for you?
We're looking at US-based ETFs. Now look, you already know they're basically the cornerstone of domestic investing here in the States, right? But today, we're moving way past the absolute basics. We're going to look at the actual best practices for optimizing your exposure to the American market. Whether you're fine-tuning a massive portfolio or just trying to squeeze a bit more efficiency out of your domestic assets, we are going to extract the real, tactical insights you need.
So, are you truly ready to navigate US ETFs? I know, it sounds super straightforward, right? But building a genuinely optimized domestic portfolio goes way, way beyond just buying a broad index fund and walking away. You've got to consider things like tax efficiency, avoiding accidental sector overlap, and of course, fiercely managing those expense ratios. Okay, let's dive into this, because by the time we finish up today, we're going to elevate your strategy from merely participating in the American market to actively maximizing its full potential.
Here's our roadmap for today's explainer. First, a quick intro to US ETFs. Second, we'll cover core best practices. And third, building your strategy. Let's get right to it.
Section 1. Intro to US ETFs. The basics. Okay, so a USA-based ETF is essentially your introductory vehicle for investing in a diversified basket of American assets, kind of like a sampler platter of the US economy.
But, the true nuance for an informed investor lies in exactly how that basket is put together. We aren't just talking about a random assortment of companies here. We're looking at specific weighting methodologies. Think market cap weighted versus equal weight, for example. In today's landscape, where a massive chunk of the S&P 500's performance is, let's be real, heavily concentrated in just a handful of massive tech companies, understanding exactly what American assets your ETF is actually tracking is literally what separates average returns from optimized growth.
Now let's look at investing in a single U.S. stock versus investing in a USA-based ETF. And this brilliantly illustrates the core advantage of mitigating unsystematic risk. Even the absolute best, most established American blue-chip companies carry inherent, single-company risks. Think about it. A bad earnings call, a sudden change in leadership, maybe some unexpected regulatory hurdles. By utilizing an ETF, you're smoothing out that unsystematic risk while effectively capturing the systematic risk, which is basically the broader, historical upward trajectory of the U.S. market itself. It's just a far more efficient way to capture domestic growth without tying your entire financial fate to a single corporate boardroom.
All right, moving into Section 2, Core Best Practices, the Game Plan.
Let's see how this builds across our core implementation steps. Step 1. Research U.S. ETFs. Now, this doesn't just mean glancing at the top 10 holdings. No way. Serious research means digging into expense ratios, really understanding the bid-ask spread, and aggressively checking for fund overlap. You definitely don't want to accidentally buy the exact same tech giants 3 times over across different funds. Then, Step 2. Select based on goals. You've got to balance growth versus dividend yield, based directly on your own current tax brackets and time horizons. And finally, Step 3. Monitor performance. You aren't just looking at the daily ticker price here. You need to be actively monitoring the tracking error to ensure the fund is tightly mirroring its target index without just sort of drifting off over time.
Expanding on these practices means focusing heavily on USA market fundamentals. And right now, well, that means keeping a really close eye on macroeconomic indicators, like Federal Reserve interest rates, inflation data, and that heavy tech weighting of the major indices we talked about. Diversifying your introductory selections requires moving way beyond just the S&P 500. Think about maybe incorporating the Russell 2000 to capture some of that small-cap American growth, or even sector-specific funds that align with broader demographic shifts. And above all, sticking to established best practices means utilizing tax loss harvesting and maintaining proper asset allocation, completely regardless of whatever the financial news cycle is panicking about on any given Tuesday.
Now, what's really interesting here is the emphasis on mastering the introduction before applying the more complex best practices. It's incredibly tempting to jump straight into flashy instruments like options trading or highly leveraged funds, but the data tells a remarkably consistent story. Mastering the boring basics, like a low-cost, broadly diversified US ETF strategy, routinely outperforms hyperactive trading over a decade. Actually, year after year, studies show the vast majority of active stock pickers completely failed to beat their benchmark indexes. The real edge isn't in those flashy tactics. It's in the ruthless, disciplined execution of these core fundamentals.
Section 3. Building your strategy, putting it together.
So, the crucial point is this. We need to synthesize everything into a truly durable framework. Start with a strong introduction to the specific mechanics of your chosen funds. Then, apply those core best practices consistently by managing those expense ratios and closely monitoring tracking errors. And finally, maintain your focus on USA-based asset growth. Ultimately, as an American investor, your true edge in wealth building comes down to consistency, minimizing your fees, and confidently capturing the long-term compounding growth of the domestic markets. Honestly, that disciplined repetition, that is the actual engine of true portfolio growth.
So, the big question remains, how will US ETFs shape your portfolio? Will you use these tools to build a highly tax-efficient, steady retirement? Or maybe to aggressively target sector-specific domestic growth? The American market is incredibly dynamic, and the tools to conquer it are right here in front of you.
I am so excited to have you here today because, look, we are tackling something that is literally a cornerstone of American wealth building, U.S. dividends. But hey, we're not going to beat around the bush or get bogged down in endless financial theory, right? Here's your bottom line up front. To really leverage U.S. dividends to build your wealth, you absolutely need a firm grasp of how these profit-sharing payouts work. But you've got to combine that with non-negotiable best practices to protect your hard-earned money from those dangerous yield traps. Today is all about laying down that essential groundwork, step by step.
So, are you ready for the essentials? Let's just be totally real for a second. If you're an everyday American, maybe sitting around the kitchen table right now trying to map out your financial future, man, it is incredibly easy to feel totally buried under a mountain of Wall Street jargon. Sometimes it feels like they're speaking a completely different language. But today, we are cutting out all that noise. We're ditching the complex terminology and getting straight to the core principles. If you're looking to get a clear, practical handle on this topic without the headache, you are definitely in the right place. All right, Section 1, Introducing U.S. Dividends. This right here is our foundational block. Because before we can even think about diving into complex investing strategies, we have to define the core framework. At its absolute most basic level, a U.S. dividend is simply a publicly traded American company taking a portion of its earnings and distributing it directly back to you, the shareholder. You own a piece of the business, so you get a cut of the profits. It's literal cash deposited straight into your account. And, people love to rush to the complex, sexy strategies. But if you skip understanding this fundamental mechanism, like how companies actually generate the cash flow required to pay you consistently, you're basically building a house on sand. We're keeping things fast-paced today, but we're absolutely not skipping this groundwork. A solid, no-nonsense introduction sets the stage for literally everything that follows. It's really about knowing exactly what game you're playing. See, when you invest for dividends, you aren't just crossing your fingers and hoping the stock price goes up so you can sell it later for a quick gain. No, you are actively buying an income stream. Understanding that baseline shift in mindset, that is the field you're standing on. It completely changes your rules of engagement before you ever even make a move. Moving right along to Section 2, Defining Best Practices. Let's establish the rules of the road. And this brings up a pretty crucial comparison, right? Like, why do we even need rules? Well, an introduction all on its own is essentially just raw information. Just knowing what a dividend isn't nearly enough to protect you from a bad investment. For example, without best practices, an investor might just chase the absolute highest dividend yield they can find, totally unaware that a sky-high yield often means the company is in severe financial distress. It's a huge red flag. But with best practices in place, that same investor stops, checks the payout ratio, and makes sure the company can actually afford those dividends long-term. The true value is really unlocked when the baseline introduction is paired directly with these protective established rules. We can actually organize this whole approach into a highly actionable two-step structure that I think perfectly appeals to that practical, roll-up-your-sleeves American mindset. Step 1, understand the concept. You're buying an income stream from profitable companies. Step 2, apply the best practices. This means doing things like diversifying across different sectors and analyzing a company's history to see if they consistently raise dividends over time. You identify the concept, and then bam, you immediately attach the proper way to execute it safely. It's a highly pragmatic, no-excuses approach that keeps you totally focused on what actually works for building lasting wealth. Which brings us to Section 3, the final takeaway, the ultimate bottom line. U.S. dividend introduction with best practices. This is the definitive takeaway that unites both the concept and the application into one completely unbreakable idea. You just cannot separate them if you want to be successful. You've got to understand the fundamental mechanics of profit sharing, for sure, but you must strictly apply the rules, like checking those payout ratios and avoiding those dangerous yield traps we talked about, to ensure those profits actually last. The introduction gives you the what, and the best practices give you the how. And when you fuse these two elements together, you've built yourself an incredibly solid, lasting financial foundation. So, the big question, how will you apply these best practices? That's the provocative thought I want to challenge you with as we wrap up today. You've got the foundational framework now, and you recognize that rules like analyzing dividend history and avoiding those unsustainably high yields are absolutely non-negotiable next steps. So sitting there today, looking at your own financial journey, how are you going to take this exact foundation and put it into practice in your own portfolio?
Looking at the absolute powerhouse engine that is American compounding growth and exactly how you can use best practices to actually make it happen. We are talking about the core mechanism driving U.S. enterprise, right? That structural advantage that every high-level founder, investor, and builder in this country uses to their advantage. It's the reason why some companies are just stuck with stagnant margins forever, while others systematically capture dominant market share. But beneath the surface of those flashy overnight success stories lies a highly specific, repeatable mathematical process. So in this explainer, we're going to break down the exact mechanics of how operational moats and capital reinvestment build on each other. We'll look at why our American business ecosystem accelerates this and map out the strategic practices you need to trigger this whole phenomenon.
So what is the true mathematical mechanism behind explosive, literally unstoppable growth? Take a second and really challenge your assumptions here. A lot of folks just assume massive success requires some crazy black swan event, like going instantly viral or inventing a completely unprecedented technology out of thin air. But the reality, it's far more pragmatic and it's rooted in rigorous execution. The true mechanism isn't a single explosive launch, it's a relentless mathematical formula. It's a mechanism that starts incredibly small, focusing on incremental basis point improvements, but holds within it the power to completely restructure an industry's economics over time.
10,000x. Just let that number sink in for a second. That sounds insane, right? But this isn't some hyperbolic target. It is historical American market reality. Think about the classic compounding machines of the US economy. A simple $1,000 investment in an early public company like Amazon, or the systematic capital allocation of Berkshire Hathaway, didn't just double. It underwent a 10,000-fold multiplication over decades. Now imagine applying that compound annual growth rate, that CAGR, to your business's revenue, your operational efficiency, or your customer lifetime value. When you successfully harness this mathematical leverage, a 10,000-fold return is the logical, inevitable end state of the math just compounding in your favor.
Moving right along to Section 1, the magic of compounding.
Okay, so compounding growth. It's basically the process where your initial growth generates even more subsequent growth over time, creating this massive snowball effect. But let's elevate that concept from a textbook definition into pure business strategy. This is all about building economic moats and leveraging capital reinvestment. Your initial investment, whether you're deploying capital, writing a new code base, or, say, optimizing a supply chain, produces a return. Instead of just extracting that yield and walking away, you reinvest it right back into the business. So in the next cycle, you're generating a return on your original asset base plus the retained earnings from the previous cycle. Over time, this drives down your customer acquisition cost, increases your operating leverage, and creates an environment where growth literally funds its own exponential expansion. And that is the true engine of compounding.
Now you've really got to see the fundamental difference here between the sheer exhaustion of linear labor and the massive leverage you get with compounding systems. Linear growth, that's just trading hours for dollars. 1 unit of effort equals 1 unit of output. You add a salesperson, you acquire a few more accounts. It is predictable, sure, but it relies entirely on continuous manual effort. Compounding growth, on the other hand, operates on explosive exponential multiplication. This is where your standardized operating procedures, your automated workflows, and your reinvested capital do the heavy lifting, entirely independent of your physical time. While linear frameworks will eventually burn you out, compounding frameworks scale effortlessly. They lead to this explosive upward trajectory where results are completely divorced from your daily manual input.
Which brings us to Section 2, the USA growth context.
Now, compounding growth is a universal law, absolutely. But the USA environment acts as a really unique accelerator through that pragmatic, can-do, entrepreneurial spirit we're known for. And this isn't just about having a good attitude. It's about our structural and legal infrastructure. The American market is uniquely optimized to grease the wheels of rapid reinvestment. From standardized venture capital term sheets and the legal framework of Delaware C-Corps to highly fluid labor markets and massive, unified consumer demand, the whole ecosystem is designed to remove friction. When an American enterprise identifies a positive unit economic model, the capital markets allow them to pour fuel on that fire and scale the formula faster than anywhere else on the globe. It's an infrastructure built explicitly to maximize exponential multiplication.
Let's get into the how-to with Section 3, implementing best practices.
Triggering this whole dynamic requires a highly structured playbook. First up, Step 1, establish consistent foundations. Look, you absolutely cannot compound a broken system. You need rock-solid, scalable unit economics. Next, Step 2, implement best practices rigorously. And I don't just mean basic customer service. We're talking about automating operational workflows, establishing compounding flywheels, and utilizing data to optimize every single point of leverage. You literally must tune the operational engine to absolute perfection. Finally, Step 3, allow compounding to take over. This requires immense strategic discipline. You have to let the automated systems run, aggressively reinvest the margins, and just have the patience to let that mathematical curve accelerate. All right, let's tie this all together in Section 4, a real-world example.
Let's ground all this theory by looking at a classic American growth story, Domino's Pizza. Think about their early operational timeline. Year 1, it wasn't about aggressive global expansion. Actually, it was about rigorously perfecting a highly specific standard operating procedure, that famous localized 30-minute delivery system. It required heavy foundational effort, with seemingly tiny initial returns. But by year 3, the momentum visibly shifted. They began franchising that exact, perfected SOP. The compounding flywheel was activated, driven by standardized systems and reinvested franchise fees. Then, by year 5, they realized exponential national takeover. That massive scale was completely dependent on surviving the localized grind of year 1 and strictly adhering to the compounding system through year 3.
And this right here is the absolute proof of operating leverage in action. You'll notice the initial growth always appears kind of flat, representing that early foundational stage where the systems are literally just being built. Then we see the steady build, the franchise model, or the automated software really starts to gain measurable traction. Finally, we hit the explosive compounding peak. This drastic upward inflection, that deeply satisfying hockey stick curve, is the exact moment network effects take over. The cost to acquire a new customer or launch a new location drops drastically towards zero, while the revenue per unit just absolutely soars. This isn't a gradual step up, it is exactly what happens when a finely tuned American enterprise clicks into gear, the economic moat solidifies, and exponential multiplication simply takes over the market.
So I'm going to leave you with this final, provocative thought. We've examined the underlying math. We've unpacked the unique structural advantages of our American entrepreneurial ecosystem, and we've analyzed the precise strategic framework of establishing scalable foundations and leveraging time. The only variable left is execution. So how will you apply these USA compounding best practices to spark your own exponential growth today? What systemic operational lever can you pull right now that's going to compound for you tomorrow? Don't settle for the exhaustion of linear effort. Build scalable systems, respect the math, and let that compounding effect propel you toward that 10,000x future.
We're unpacking the core mechanics and the absolute best practices of dollar cost averaging. Look, if you've ever felt completely overwhelmed by the 24/7 financial news cycle, or, stressed out about exactly when to put your hard-earned dollars into the market, you are definitely in the right place. We're going to look at how everyday Americans can build serious, long-term wealth without the stress, without the guesswork, and without needing a fancy finance degree. We'll figure out the exact strategy that takes market volatility and literally turns it from a major source of anxiety into your absolute greatest wealth-building asset. Let's get into it.
So here's our agenda for today's explainer. We're going to hit the market timing trap, look at what dollar cost averaging actually is, break down how the strategy actually works, go over the best practices for DCA, and finally wrap up with winning the long game.
All right, Section 1, the market timing trap. We really got to start by addressing this universal financial anxiety that literally affects everyone. From young professionals opening that very first brokerage account, all the way up to middle-class families trying to plan for retirement. It's that paralyzing fear of, oh man, what if I buy at the absolute top of the market? It's a question we all ask ourselves when we're watching the financial news networks flashing red and green all day. Can you actually time the stock market? Well, when you really dig into it, relying on perfect timing turns out to be an emotionally exhausting and, frankly, nearly impossible strategy for everyday wealth building. I mean, even the pros on Wall Street get this wrong all the time. Waiting around for that so-called perfect moment to invest, it usually just leads to total paralysis.
And when you actually compare these two mentalities side by side, the contrast is just stark. On one hand, you've got market timing. It's highly emotional, packed with anxiety, and usually involves throwing these erratic lump sums into the market just based on a gut feeling or some scary news headline. But on the other hand, we have dollar cost averaging. It's logical, it's incredibly low stress, and it relies on a rock-solid, consistent schedule. Honestly, it's the difference between gambling on a coin toss versus building a brick wall, one steady brick at a time.
Moving on to Section 2. What is dollar cost averaging?
So the crucial takeaway here is the definition itself. Dollar cost averaging, or DCA, is the practice of investing a fixed dollar amount on a regular schedule, completely regardless of the asset's fluctuating price. I really want you to focus on those two elements for a second, a fixed dollar amount and a regular schedule. You're essentially putting blinders on, you're committing to this strategy, and effectively ignoring whether the stock market is currently hitting all-time highs or going through a really steep correction.
Now, you might be wondering, why is this so incredibly powerful? Well, because it allows you to completely remove the emotion from investing. Look, human beings are naturally wired to do the exact opposite of what makes a good investor, right? We want to buy when everyone else is super excited and prices are sky high, and then we want to panic sell when everyone's terrified and prices are rock bottom. But by focusing entirely on consistency, this approach empowers you. It completely removes that emotional panic that's so often triggered by sensationalized financial headlines. You aren't guessing anymore. You finally have a system.
Okay, Section 3. How the strategy actually works.
It is really fascinating to see how the math behind this actually plays out. Let's say you commit to investing $100 a month. In month 1, the share price is $10, so your $100 buys you exactly 10 shares. Simple enough, right? But then in month 2, the market takes a dive. The news is totally panicking, and the share price drops to $5. Now, if you were trying to time the market, you'd probably be terrified. But with DCA, your consistent $100 investment automatically buys you 20 shares. You literally just loaded up while the asset was on a massive sale.
Then in month 3, the market booms. The price shoots up to $20. Your same $100 now buys you just 5 shares. You bought fewer shares when they were expensive and way more when they were cheap, all without ever having to even think about it.
Implementing this brilliant strategy really just boils down to 2 super simple, highly effective steps. First, pick a fixed dollar amount you can actually afford. This could be $50 a week or maybe $500 a month. Just make sure it fits comfortably into your budget. Second, set an automated recurring schedule. Whether you're setting up your workplace 401k or just a personal brokerage account, you can automate this literally today. Set it for the day after your paycheck clears and simply let the technology do all the heavy lifting for you.
Let's slide into Section 4, Best Practices for DCA.
When it comes to straightforward American-style personal finance, there are a few absolute golden rules we need to cover. First up, commit to consistency over perfection. It doesn't matter if you missed the absolute bottom of the market. What actually matters is that you bought this month and you're going to buy next month. Second, automate your contributions. Seriously, if you have to log in and manually click buy every single time, your emotions are eventually going to get the better of you. Make it automatic. Third, ignore the daily financial news panic. The media makes their money by keeping you anxious, but your wealth is built by staying calm. And finally, the ultimate rule here, never, ever pause your investments during market dips. Remember that math we just looked at? The dips are exactly when your fixed dollar amount is buying the most shares. Stopping during a dip completely ruins the entire mathematical advantage of the strategy.
And finally, Section 5, winning the long game.
When you track this strategy over time, you start to see this massive snowball effect. At 1 month in, while you've just set your automation, it might not feel like much has changed yet. At 1 year, you're really starting to see those shares accumulate, and you've actually survived a few market ups and downs without panicking. Huge win. But look at year 10. Over a decade, your cost basis, which is the average price you paid for all those shares, has completely smoothed out. So while the day-to-day market might be a total roller coaster, sticking to your DCA best practices over the years builds serious, undeniable financial momentum.
And it all comes back to this classic piece of financial wisdom. Time in the market beats timing the market. Everyday wealth really is built on steady, discipline, patience, and just pure consistency. It isn't built on Wall Street insider secrets or getting lucky on some random single stock pick. It's about getting out of your own way and letting time and math work together in your favor.
So I want you to look at your own financial habits right now and ask yourself this one final question. Will you let market anxiety dictate your future, or will you automate your wealth today? The choice, and honestly, the tools to confidently win the long game are entirely in your hands right now.
Let's just jump right into it. If you've ever stepped foot inside an American boardroom or, pitched a high-stakes idea to your team, you already know the vibe. It's electric, right? It's totally charged with ambition. But underneath all that drive, there's always this fundamental tension. Today, we're unpacking the ultimate U.S. corporate playbook, the dynamic of risk versus reward, and specifically, how it's governed by USA-based best practices. We're going to break down the exact methodology that separates those flash-in-the-pan failures from the true, enduring success stories across the American business landscape. Okay, let's dive into this, because it really all boils down to one question. How do we bridge the gap between a wild gamble and a guaranteed win? Look, let's face it, every great American business venture starts with a leap into the unknown. But there is a massive difference between just closing your eyes and jumping, and actually calculating your trajectory so you land exactly where you need to be. You want that win. But that space between where you're standing right now and that ultimate victory, it's filled with uncertainty. Bridging that gap is the core action-oriented dynamic of strategic decision-making that we'll be focusing on today. Section 1, the risk-reward dynamic. This is the core tension that really acts as the starting point for any corporate playbook. And this brilliantly illustrates that inherent tug-of-war in business. Over on the left, you've got risk. The potential for loss, the crazy unpredictability of the market, and just the sheer cost of taking action. But then, on the right side, you have the reward. We're talking market share, revenue growth, basically the ultimate goal. The honest truth, blind risk without a system is incredibly dangerous. You absolutely cannot just cross your fingers and hope for the best. But at the exact same time, you can't reach that reward without pulling through the risk. The secret here isn't to ignore this dynamic, is to completely master it. Which leads us nicely right into Section 2, defining USA best practices, or as we like to call it, the playbook. So we're defining USA-based best practices as the ultimate mitigating framework and structural methodology used to govern risk and optimize results. Okay, but what does that actually mean for us on the ground?
Well, it means using specific, highly evolved practices that are native to our really rigorous American corporate environment. We're talking about things like phased venture capital funding, where capital is only unlocked as you hit specific performance milestones, which totally limits your financial exposure. Or, rigorous beta testing protocols and strict layered compliance structures. Think of these methodologies as the mentor in your business journey. When you apply this structural framework, you're fundamentally transforming what would be a sheer gamble into a highly calculated, totally defensible play. You do that by taking absolute control of the variables. Let's move on and see how this builds into a really fast-paced, actionable sequence. Step 1. Identify risk. You absolutely have to see the board clearly, audit those vulnerabilities, and know exactly what you're up against. Then, step 2, deploy USA-based best practices. This is where you bring in that mitigating framework. When the market shifts, you don't panic, you execute the playbook. You run the compliance checks, you phase the funding, you test the data. And finally, step 3, capture reward. Because you properly identified the threat early on and then deployed the right structural methodology, you're now positioned to actually claim that victory. It is a precise 1-2-3 mechanism for sustained growth. Moving right along into Section 3, balancing the ultimate equation, specifically within the American context. Now, what's really interesting about this slide is that when you integrate these 3 elements, a truly balanced strategy emerges. Look, applying USA best practices doesn't just magically eliminate risk entirely. That's a total myth. Mitigated risk is always going to be part of the equation. But what the playbook actually does is structurally optimize your path to that potential reward. By wrapping your risk up in these proven methodologies, you contain it. You keep the strategy perfectly balanced, so your entire operation can just keep driving forward without completely derailing the second that friction hits. So the crucial point is this. If you take away anything from our explainer today, let it be this exact sequence. First, acknowledge the inherent risk. Don't hide from it. Map it out. Second, ground your strategy in USA-based best practices. Use that structural methodology to build your bridge right over the gap. And third, maximize the optimized reward. Why? Because when you govern the downside with absolute discipline, your upside finally has the freedom to truly scale. These elements link together seamlessly for a winning, high-performance outcome. So I'll leave you with this question. What is your optimized risk-to-reward ratio, and are you executing the best practices playbook to maximize it? Whether you're navigating Wall Street, Silicon Valley, or just Main Street right here in the US, your professional risk tolerance basically defines your ceiling. Are you out there just taking wild gambles, or are you deploying a real structural methodology to guarantee your win? Take a hard look at your own playbook today.
I'm talking about asset allocation. So many of us just log into our retirement accounts, stare at this massive wall of confusing mutual fund names, maybe pick a few that sound good and just cross our fingers, right? Well, there's actually a real science to this. Today, we're going to break down the foundational principles that can seriously help secure your financial future. We've got a super clear roadmap for today. We'll start with what is asset allocation, then why it matters for you. Next, we'll hit some US investing best practices, and finally, adjusting through your life. By the end of this, you're going to know exactly what this means for your 401k or IRA. All right, part 1, what is asset allocation? Let's just go ahead and shatter the intimidation factor of all this financial jargon right out of the gate. The really crucial takeaway here is that asset allocation is literally just how you spread your money out to protect your nest egg while still going after some growth. It's the strategy of dividing up your investment portfolio across different asset categories. Usually that means stocks, bonds, and cash. It's just a way to actively balance your risk and reward. That's the whole shebang. It's not about finding some magical secret algorithm. It's simply about intentionally organizing your money into different buckets based on what you actually need that money to do. And it really comes down to 3 main categories when building out a financial future. Up at the top, you've got your stocks. Their primary job is growth and appreciation. But, they come with a high risk level. They bounce around a lot. Then we have bonds. These are designed for income and capital preservation, sitting at a much more moderate risk level. And finally, cash. The goal here is pure liquidity and safety, which means low risk, but also the lowest return. Honestly, your entire investing journey is essentially just figuring out the perfect mix of these 3 asset classes. Now that we've got the definition locked in, let's look at part 2, why it matters for you, the everyday American investor. An absolutely incredible 90%. Seriously, studies consistently show that up to 90% of your portfolio's returns are dictated by your overall asset allocation, rather than just picking individual winning stocks.
I mean, think about the financial news cycle, right? We are constantly bombarded with alerts about this controversial CEO or that hot new tech startup or which individual stock is surging today. But the reality? 90% of your long-term success comes from the simple, quiet math of how you divide your money between stocks, bonds, and cash. To really visualize how this works, think of your portfolio kind of like drafting a sports team. Stocks, they're your offense. They're out on the field trying to score points and drive massive growth. Bonds, on the other hand, are your defense. Their job is to protect the lead and preserve your wealth when the opposing team, the market, starts pushing back. And cash? That's your bench. It's sitting on the sidelines, totally safe, just waiting to be deployed for sudden emergencies. You literally cannot win a championship with a roster made entirely of quarterbacks. You absolutely need a strong offense, a solid defense, and a reliable bench to win the long game. This directly contrasts the golden rule of diversification against a really common American misconception, the idea that you just need to pick the next big tech stock to secure your entire retirement. A diversified asset allocation spreads risk across multiple asset classes to smooth out market volatility. If one sector takes a hit, the others can help balance it out. But single stock risk? That concentrates all your potential risk and reward into the totally unpredictable performance of one single company. Look, betting your entire retirement on one stock isn't investing, it's just gambling. Diversification is how we build a truly resilient portfolio. Let's move right along to part 3, U.S. investing best practices. We're going to outline the actual rules you can apply to your investments right now. Okay, before we even talk about specific percentages, a core U.S. best practice is just making sure you're using the proper financial vehicles to shield your money from unnecessary taxes. You absolutely want to maximize tax-advantaged accounts, like your employer-sponsored 401ks and your personal IRAs. By applying your asset allocation strategy inside these specific accounts first, you're allowing your investments to grow either tax-deferred or completely tax-free. And that drastically amplifies your compound interest over time compared to just using a standard taxable brokerage account. It's a real game changer. So what does a strategy actually look like inside that 401k? Well, an aggressive portfolio sees stocks dominating at 80%, with bonds at 15% and cash at just 5%. If you've got a really long time horizon, like say you are decades away from retirement, an aggressive portfolio relies heavily on the offensive stocks to absolutely maximize growth. You have the time to ride out the inevitable dips and crashes of the stock market, so you can totally afford to take on that higher risk for a higher potential reward. On the flip side, though, for a conservative portfolio, the script is entirely flipped. Now bonds make up a massive 70%, stocks are reduced to 20%, and cash is up to 10%. This setup relies heavily on the defense of bonds. This is the absolute best practice when you're nearing retirement and you really need to protect what you've built. When you're going to need to start actually withdrawing this money to live on in a few years, you just can't afford a sudden 30% drop in the stock market. So you trade that high growth potential for high stability. But, setting their percentages once and forgetting it, that just isn't going to cut it. A fundamental best practice is this process called annual rebalancing, which really just involves 3 simple steps. First, review your target allocation percentages. Second, assess your current portfolio mix. And third, buy or sell assets to restore those original targets. Why is this so necessary? Well, let's say your stocks have an incredible year. They might grow to become 90% of your portfolio instead of your target 80%. Suddenly, your sports roster accidentally has way too many offensive players, meaning you're taking on too much risk. Rebalancing forces you to sell high and buy low, naturally restoring your intended balance. For our final section, we're looking at part 4, adjusting through your life. We're charting the actual chronological journey of an American investor. Your strategy definitely shouldn't be static. It must actively shift from offense-heavy to defense-heavy as you age. At age 25, your focus is aggressive growth. You can absolutely afford the risk. By age 45, you enter your peak earning years, and your focus shifts to balanced wealth building, kind of leveling out that risk. And finally, by age 65, your goal transitions to conservative income and preservation. Bottom line, your portfolio has to evolve as your life circumstances evolve. In practice, the percentage of equities, meaning your stocks, generally decreases as your time frame to retirement shrinks. You start with the massive 90% equity exposure at age 25. By age 45, you've dialed it down to 60%. And by the traditional retirement age of 65, you're down to a highly defensive 40%. This downward slope is often called a glide path, and following it is honestly one of the smartest things you can do to ensure a totally smooth landing into retirement. To tie all of this together, I love this quote. The most important key to successful investing can be summed up in just 2 words:
asset allocation. That perfectly summarizes everything we've covered in this explainer. It's really not about being some kind of stock-picking genius. Structure, discipline, and balance, those are the true secrets to actually achieving the American dream of financial independence. I want to leave you with this final, absolutely vital question to ask yourself the very next time you log into your retirement account. Is your portfolio built for your tomorrow? Does your current asset allocation actually reflect your age, your risk tolerance, and your real financial goals? Take 15 minutes this week to just check your necks, consider a rebalance, and make sure your money is structured to serve you for the long haul. Thanks for hanging out with me to explore this concept and keep building that financial future.